This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Books of prime entry. Now in this chapter I'm not going to work through the example. You can look through the example yourself and check with the answer, but let me explain what the books of prime entry are. In the exam you won't be asked to write up any of these books, but the names could be mentioned, so it is important that you know what the books are and how they fit into the accounting. And the point about them is this, that in all the earlier chapters when we looked at double entry, if I said, for instance, we buy goods on credit for $100, then no problem. To buy goods on credit, you debit purchases, you credit payables. Now that is the entry, it's no problem. And in the questions we've been doing, no problem at all. There've only been 6, 7, 8 transactions. It's no problem opening up the T accounts, debiting, crediting. But of course in practice there can be thousands of transactions a day, and it's just unrealistic. Every time you buy goods, debit purchases, credit payables, to be doing that 1,000 times a day would just be impossible. And so what happens in practice is that there'll actually be several bookkeepers, and they'll be recording each transaction in one of various books without actually doing any debit credit. They'll just keep lists of all the transactions, and it's later that we'll worry about the debit credit. Now the books they'll use, in practice there can be all sorts of books, but there are certainly 4 main books involved, because there are 4 main types of transactions. The 4 main types of transactions, the bookkeeper, you'll receive cash, pay cash, buy goods on credit, sell goods on credit. So those are the 4 main types of most transactions of any business will be one of those 4. Pay cash to buy something, receive cash for your sales or whatever, buy goods on credit, sell goods on credit. For most businesses they are the most of the transactions, and so the main 4 books are books in which we'll just list each of those. And running through them, there'll be the cash book, but there'll be 2 parts to it. There'll be cash book receipts, and this will simply be a list of all cash receipts. No debit, no credit, just a list. The only thing is, though, of course, there are several different reasons the business might receive cash. They might receive cash because they've made cash sales. They might receive cash because a receivable is paid. Well, so we don't forget the reason, they'll have what we call an analysed cash book. And although it will simply be a list, it'll look something like this. Just writing the headings: description, amount, and then analysis. You might have columns such as sales, receivables, capital. And what we do is this: every time you receive money, so perhaps, first of all, the owner puts in 5,000. Well, we'd write a description, write owner or the owner's name. The amount we've received is 5,000. But of course if it's money from the owner, it's capital. Well, so we don't forget it's capital, we also put 5,000 in a column headed up capital. We might then receive 500 for cash sales. Sales, the cash received 500, list it, But so we don't forget, we'd put 500 in a sales column. And so on. A customer, perhaps Mr. A, owes us 1,000. Pays us 1,000. It's from a receivable. So receivables column. Perhaps we make more cash sales of 600. The sales column, and so on. So it is simply a list. Every single receipt would be entered. We'll analyse it so we don't forget what the receipt was for. But at that stage, we've done no debit and no credit. It's simply a list. In a similar way, there'll be another book, Cash Book Payments. Where in exactly the same way, we'll list every payment. There'll be a description. There'll be an amount. But then we'll analyse it into the reason for the payment. Now, of course, payments, there could be lots of reasons. You may have made cash purchases. Maybe you paid payables. Maybe you paid rent. Maybe you paid electricity, whatever. There'll be lots and lots of columns. In practice, these used to be very long books, very wide books, but you'll have a column for each type of payment. And so in the same way as before, suppose we buy goods for 200. Purchases, 200 in the purchases column. Suppose you pay Mr. X. You owe money to Mr. X of 5,000 and you pay him 5,000. It'd be in the payables column. Rent of 100 would be in the rent column, and so on. Again, no debit, no credit. Simply a list, a record of every payment, analysed into columns for whatever the reason was. Now, in fact, in practice, you generally find that those two books simply record cash in and out of the bank, because again, for most businesses, most of their money's in the bank. So cash book receipts would be cash into the bank, payments cash out of the bank. There'd probably also be a petty cash book, and I won't show one here because in exactly the same way as we've just done, this would be listing all what you might call loose cash, received and paid. Of course, for a shop, there'd be a lot of pure cash. For most businesses, though, most of the money, I've already said, is at the bank, but they will normally have some ordinary cash, small amounts. Well, there'd be another book recording that. However, although we've now got a way of listing all the cash transactions, the other two big types are sales and purchases on credit. And so we'd have a book listing all purchases on credit. We'd call this the purchases journal. Or, now this can be very confusing, it's the purchases journal, or sometimes called the payables journal, or daybook. Daybook is now a bit old-fashioned, but purchases journal, purchases daybook, payables journal, payables daybook. But what this is, whatever we choose to call it, it's simply a list of all purchases on credit. So it would. You'd simply list them. You'd have the name, Mr. X. You'd have the amount, perhaps $100, Mr. Y, $200, and so on. Again, no debit, no credit, simply a list of all purchases on credit. And finally, with regard to the main books, you'd have a sales or receivables journal. And this would be a list of all sales on credit. So for the last time, no debits, no credits, simply a list. But between them, those 4 books, you'll have lists of all the main transactions. I did say at the beginning, there are obviously other types of transactions that could occur, and depending on the type of business, there may well be other books. Perhaps you'll have a book listing all returns you make or something. But these are the 4 main ones, and for the exam, these are the 4 ones to be aware of. Now, they're called books of prime entry. Sorry, my writing's very good. Books of prime entry, or first entry. And the important thing is they are simply lists. There's no double entries. Well, of course, we do need a double entry. However, there's no rush, because it's only when we want to do things like prepare financial statements that we need the debits, credits, we need the T accounts. And normally, most businesses would only do that at the ends of months. And so although there's no rule, what generally happens is that we list in those 4 books, and at the end of the month, at end of months, we do the double entry to the T accounts. And remember, the accounts, it's quite a long time since, I think it was chapter 3, but are in the nominal ledger. So there must be a debit and a credit. Although we are rather efficient. If you look back to my little example of cash receipts, in the cash receipts book, you'll have listed every individual receipt. I've got 4 there. In practice, there might be 4,000. We need debits, credits, and of course, the first one, the double entry, it was capital, so debit, cash, credit, capital. The second one, debit, cash, credit, sales, etc. But instead of doing 4,000 debits, credits, all we do, we take the total at the end of the month. And remember, we've only 4, pretend there are 4,000, but the total 7,100. That's the total receipt. Here, 1,100 of it is cash sales, 1,000 is receivables, 5,000 is capital. And we do the debits, credits using the totals. And so using the totals, if I just make a bit of space here, instead of doing in the cash account lots and lots of little debits, in the cash account, in the nominal ledger, we'd have one big debit of 7,100. The credits, well, to sales, we'll have one big credit of 1,100. To receivables, 1,000. And to capital, 5,000. So we have done the double entry. It's one big debit and 3 little credits, but we do it in total. And I think clearly that's a lot more efficient if there had been 4,000 entries. List them all in this book, but the debit or credit, we just take the totals of each column. And similarly for the other books as well. Shouldn't need to go through in detail here, but the purchase journal, the total is 700. When you buy goods on credit, it's debit purchases, credit payables, but instead of doing each one separately, we'd just have one big debit to purchases and one big credit to payables. It's more efficient, it saves time. Again, you won't do this in exams, but be aware that in practice this is what would happen. Finally, one more thing that's going to be important. If you think about what I've just been saying, on your receivables account in the nominal ledger, the total sold on credit we'd find out from the sales journal. And maybe during the month we've had total sales of 20,000, in which case you debit receivables 20,000. From the cash receipts book we'd find the total receipts. We'll have a column for all the cash received from receivables, and maybe our total receipts, I'm inventing a figure obviously, were 15,000. We'd have a balance at the end of the month of 5,000. And of course, for the balance sheet, all we need for receivables is to know the total we're owed. Under current assets, receivables 5,000. But for practical reasons, it would be very important that the company had kept a record of who actually owed us that money. Of course, we could have been selling to 50 different people. That 5,000 is the total of maybe 50 individual balances. And so, in fact, we'll have two other books. We'll have a receivables ledger and what this is, it's a book where we'll have a bookkeeper keep a note for each individual customer of how much they owe. Now it's very likely to be a book effectively using T accounts, but we could keep a record any way we wanted. But here we keep a record for each individual customer. So although in the nominal ledger we know how much we're owed in total, and that's the double entry, the receivables ledger is just keeping a little note of who owes us that money. And similarly, there'll be a payables ledger. This will keep a record of each individual supplier. So again, we will have a payables T account where we'll know how much we owe in total, but it's in the payables ledger where we'll know who is owed that money, each individual liability. All right, well, as I've said, although I hope that makes sense, that I've explained the important books, it is important to actually work through an example. You will not be asked to write up the books in the exam, but the names of the books do matter. The names of the books will appear. So do have a work through yourself, the example 4 on page 70, and check with the answer. But finally, when you've done that, come back to this recording and you'll see on page 72 there's space to do a diagram of how the books fit together. So nothing new here, but just to summarize everything, let's do it. Now I'm going to start in the middle of the page, so if you are copying this, do the first bit in the middle of the page. The first thing we do whenever there's a transaction, we list it in one of those 4 books we discussed earlier. So we'll have 4 books. We'll have a cash book of receipts, That's supposed to be a nice box, but still. We'll have a cash book payments. We'll have a purchases or payables journal. And we'll have a sales or receivables journal. Now remember, those 4 books are simply lists. Every transaction had to be recorded in one of those 4 books, but they are not part of the double entry. No debits, no credits. And we call them the books of original or first or prime entry. Now we'll write those books up for the whole month, but as I said, usually at the end of the month we need to do the debits, credits. So at the end of the month we'll take the totals from these 4 books and we'll actually do the double entry in the T accounts. For instance, let's do that a bit neater. We'll be debiting cash, we'll be crediting sales, etc. Now the dotted lines is to show we get the information from these books, but the actual double entry is in this book here where we've got all the T accounts, capital, purchases, etc. Well, this book, remember, is called the nominal ledger. And this is the double entry. So, sorry it's not terribly pretty, but write up in the books of prime entry, take the totals at the end of the month, and do the debits credits in the nominal ledger in the T accounts. And it's from the nominal ledger that we would produce the income statement and the statement of financial position, the balance sheet. That was chapter 3, remember. But when we've done all the debits credits, we'll close off the accounts and we'll produce the financial statements. Finally, I did say that although in the nominal ledger we will have a record of total receivables, total payables, we do need to keep a note of how much each customer owes us, how much we owe each supplier. So we'll have 2 more books. We'll have a receivables ledger where we'll have a whole load of accounts for Mr. X, Mr. Y, Mr. Z, and so on. And we'll have a payables ledger where again we'll have accounts for all the suppliers, Mr. A, Mr. B, Mr. C, and so on. Now the information will come from the books of prime entry. So receivables, we find out what we've sold from the receivables journal. We find out what we've received from the cash book. And the payables, we find out what we've bought from the payables journal. We find out what we've paid from the cash book. However, these two ledgers are not part of the double entry. They're only notes. They're note, or you sometimes see the word memorandum, only. Now occasionally, but this is a very old-fashioned word and I'd be surprised you see it in the exam, but occasionally these two are called personal ledgers. Because they have the names of people or companies. So I'll say sometimes personal, but I'll put a bracket around it. You're very, very unlikely to see that name. But there we are. Now I've said twice, and I'll say for a last time, what you need to worry about is not writing up the books, but do be clear what they are, and I'll warn you, it can be very confusing. In the nominal ledger, we've got a receivables account. In fact, I'll write this down. You have a receivables account that's in the nominal ledger, and it shows total receivables. However, we've also got a receivables journal that's one of our books of prime entry, and it's simply a list of all sales on credit. We've also, though, got a receivables ledger. And the receivables ledger is where we've got a record for each individual receivable. And I'm sure you can see where the problem lies, that even if you're perfectly happy with what we've done and with example 4, it's very easy in a hurry to get confused. Receivables account, receivables journal, receivables ledger all sound similar, and yet they're all doing different things. So, I've already said do the example, have a go, and have a go at the test.